Well, we're back watching interest rate markets once again, with the market beefing up its obsession of how high rates could go. And ultimately, is there a snapping point, a tipping point ultimately where rates could cause a higher volatility and a sustained volatility in markets? Of course, the US dollar is central to everything that we explore at the moment. And we look at the key drivers of the dollar and markets more globally. This is The Trade-Off. Well, hi there, my name's Chris Weston, Head of Research here at Pepperstone. I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics. Blake, I'm going to actually bring you straight into the programme because I see you've made yourself out, you've moved out of the desert, probably a wise decision, and you've moved yourself to where?
It's Old Town Scottsdale. You know, it's about a couple miles away from where I live. And the desert, by the way, is only about 10 miles north of where I live. So, you know, we figured this would be a little bit closer to home for me. And I started my trading career just literally behind those buildings behind me. So
really, man, it looks really nice. It looks very much like a kind of Venetian type setup, sort of place that you'd kick back after a hard day's trading, a few G&Ts, with the wife and friends. So it looks like a nice little place. That's where the PGA's played, isn't it, on Scottsdale?
It is. It's the Waste Management Open is played pretty close to here. That's actually very close to my house. And it's a wonderful place to live and play golf. I mean, we have some of the best golf weather, and that's why so many tournaments are. So we have so many golf. We have so many golf courses, and tournaments love to be here, and that's why we all love to party at the PGA Waste Management Open. Very
nice indeed. Well, you know, like if I was to look out of this sunny window here, you could see the Yarra River in Melbourne, sun shining. It's a beautiful setup. You've obviously got that amazing little setup. And we go to Michael Brown in the UK trade-off, and he's looking over London's grey and dismal sky. And I think that's sort of a nice reflection on who he is as an individual as well. Only joking, Michael. We're great. Anyway, let's go into Topical Thunder and let's have a look at what's going on in the markets this week. All right, a couple of things. First of all, I talked about in the synopsis there about rates markets. Interest rate markets are the first derivative. They are everything at the moment. Yeah, this idea of hard landing, soft landing, higher for longer, all this kind of issues. But ultimately, you know, you've seen this repricing, not just in the US rates curve, but in European rates. You've actually seen some negative repricing in Australia, in the RBA. In Bank of Canada as well to an extent, and certainly some big moves in UK rates. But let's take the Fed, for example. You know, we've got the terminal price. This is the peak pricing in the interest rate markets now at 5.37%. So the Fed funds effective expected to get up to those levels. That's obviously brought up 2-year and 5-year treasuries. That's boosted the US dollar relative to other currencies as well. But you know, like we've just seen the minutes coming out. Obviously, they were stale. We've got some data coming through. You've got talking about the core PCE numbers later on this week. Market could be pretty sensitive to those. And then we're going into a wild March with non-farm payrolls, Powell speaking early in the month, and obviously the CPI number there. But this is what everyone's focused on: is how high could rates go? Could these rate cuts that are priced in for the end of the year fully come out? Are the rate cuts for next year likely to come out? But it's driving everything. So, what's your take on this? How are you looking at the rates market? How influential is that as a sort of correlation input for you to trade currencies?
Well, it's extremely important. And as we saw today, the dollar index is nearing its trend highs as a result, and you got yields rising, not only in the US, but as you pointed out across, around the world, really. But there's got to be a tipping point, Chris. I've got to assume that tipping point is coming. And I don't know if it's back above 4% on the 10-year that really start to impact the markets, where markets start, taking it not so much for granted where we're at. But it's interesting how the equity markets, at least the U.S. equity markets, and well, actually, I could almost say global. I mean, you look at Nikkei's kind of rolled off a little bit, as we pointed out a couple of weeks ago, but the DAX is holding up near its highs. You got a lot of like global equity markets that are really still holding on pretty well, considering. So, I mean, it's driving currencies and it's driving sentiment, but it isn't driving equities or risk yet. What do you think?
I think it is a bit. Look, the way I'm looking at this, Blake, is let's see what happens with the data this week. But ultimately, the elephant in the room is what happens post Powell's testimony to Congress on the 7th of March. And if that payrolls number on the 11th is going to be a biggie, followed by another core CPI number in line where we are, that 530, I know there's a lot of time between that 537 could easily be well above 5.5%. And we start saying to the market going, the Fed are going to have to upgrade their dot plots pretty substantially. And I think that would be bad. The other thing, of course, is if we were to really, really open the door to a 50 basis point hike on that 22nd of March. And again, where market's pricing about 25% chance of that. Again, I think both of those situations for me is where risk stuff suffers. And in real rates as well. Last night we saw real rates moving up 10 basis points off their lows, and that moved the dollar. So again, that they're all things that are working. These three, those are the epicenter of global financial markets for me. They're driving everything. The dollar, equity market. So if they continue to move, I think there will be a tipping point pretty soon.
Okay, well, that brings me to actually our next topic, and this is actually an important topic for traders, and it's bias. And I want to talk a little bit about it because as traders, and we talk about this, you and I discuss it here, but I had a conversation today with a trader on one of our shows regarding bias, and he was so bearish, and he's like, we're gonna trade into new lows, and we're going to new lows of the year today, blah 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 blah. And I'm like, man, you have to. It's okay to have an opinion. It's okay to have a bias, but you got to be really careful in a range environment, which we are right now, to be too attached to that bias.
Yeah.
And it's something that I wanted to throw out there and make it a topic of conversation today, because I think people get caught up in their own biases. Do you see that happening with the Pepperstone clientele?
Well, I don't speak directly to them about their biases and bits and pieces. I guess the thing we see most prominently, and this is just a retail phenomenon, it's not something that's specific to Pepperstone clients, is people are always attracted to trends, and they want to counter trend it every time. And it's the maturity of that trend, the severity of the slope up or down that just attracts them to that. And so when you do see something that's up for a period of time, then you just get people going, I've got to sell that. But if it's down for a period of time with a decent slope, they'll come and buy that, and you'll see a heavy skew doing the opposite of the trend. And of course, that's when position size or leverage rate becomes an issue. So I think that's kind of what you tend to see. Yeah. On the bias thing. I mean, we talked about it in our year-end review and or sort of look ahead for the year. Trade like a ninja. You've got to be able to adapt to the price action, adapt to the changes in the market environment. And if you don't, you're going to get caught up in those biases. Will get caught out. So you read the news, you get affected by sentiment that's there, and you decide to take a short position. The market goes up. You've got to respect that. So price action's always key, and trade like a ninja we talked about. Remember,
trading like a ninja, I think, is important. And so I want to make sure that traders are being flexible. It's okay to be wrong. Just it's not okay to stay wrong.
That's right. Yeah.
That's something that I've really learned, especially when I did some prop trading for a firm individually for many years. I learned not to stay wrong, because especially when you're not, you're trading positions, a lot of people like to add to these losing positions, and it's just not a wise decision, especially if you're really biased trading. Like, I am so bearish, I can't even see straight. So everything I'm going to trade is, risk off. But
I want to say this, right, because I actually find it really easy to get out of a trade. I as soon as I'm losing money, I'll get out. We talked about it at the beginning of the year. It's the staying in and extracting most out of a trade that's most important. And I remember you've got an interesting story about staying in the trade, right? In the early days in 1997, you've been 1 year into. I'm just about to start my career, and you got taught a big lesson about staying in trades. Tell us about that.
Yeah, I was actually right behind the backdrop of where I was at. And, I was trading a couple internet stocks, and I locked in like $5,000 worth of profits. My buddy was sitting to the right of me. He looked over and he said, or he didn't say, he went, and
he just clocked you.
He just cold cocked me. And I said, what are you doing? And he goes, why did you get out of that position? I said, I want to book some profits. He's like, you're never going to make a lot of money unless you stay with your trades. Have faith in your trades. You're profitable, move your stops at break even and stick with it. And I'm like, But that taught you a good lesson.
It taught you a lesson back in the day. I'm not sure if that would fly these days, to be honest. 1997 was a slightly different era, but you learned your lesson, and hopefully you're a much better trader as a result of that. Anyway, great story. old days. We could talk war stories all day long, to be honest, but we can't. Yeah. Producers give me a wrap up. Anyway, let's go into the equity markets, because last week I was wrong. I was talking about the Nasdaq looking for a breakout. It didn't happen. We were sort of saying, I was certainly saying, there was a lot of conflicting forces that suggested it should be going down, but it's going up, and that just. Go back to the previous section. Is just I was thinking, my gut was telling me that I wanted to sell risk, but the price action wasn't there, and I was staying long. Ultimately, we've seen the Nasdaq come off pretty sharply, S&P coming off, and Chinese equity markets coming off as a result. So my gut instinct was right, but the price action wasn't there, and I still held a long bias. Now, where are we at? If we have a look at a reflection of where we're going at the moment, and again, I throw the question to you. We've had a big pullback, a decent pullback. We've got the VIX currently trading at 22%. So there has been a bit of a propensity to buy volatility, but it's still not at extreme levels by any means. Above 30% would be that more sort of extreme read. But looking at the technicals, Blake, I know we haven't got a chart in front of us now, but how are you thinking about things like equity risk premium? Where is the balance of risk now in the near term? Do you see more upside risks or more downside risks immediately?
Well, that's a good question. I actually think it's quite balanced, to use your own term.
Okay.
I'm actually selling rallies and I'm buying dips. So to make it a little bit easier, if I can give you guys some numbers like that I'm thinking off the top of my head. Obviously, things change every day. We take in. I always like to tell people every morning I sit down. It's like sitting down with a 1,000-piece jigsaw puzzle, and I'm putting the pieces together early in the morning, trying to figure out exactly what I want to do for the day and how that picture is going to look. Every day you get thrown like different pieces of the puzzle. You're like, well, that one doesn't fit and that one doesn't fit where it's supposed to. But that's kind of the way it is. And so when I say, hey, we get towards 40, 50 in the S&P, I'm looking to sell risk. We get down towards 3,900, 3,950, I'm looking to buy risk. So you can tell I'm looking to be a ninja, trade both sides of the market, but I want to trade extremes. I'd like to see us get to, get down towards 3,950, maybe 3,900, and be long a little bit of risk. You get up about 40, 50 during, to the breakdown point from a couple of days ago, sell some risk up there. I think that's how you have to play it, because I think it is kind of balanced. I don't have a lot to go off of right now, because we all know the Fed should be hawkish. They should keep rates high. Even not just the Fed, other central banks too. The money supply should stay tight. Balance sheets are going to continue to get cut down. So stocks should come down, but they aren't, right? So what do you think, Chris?
Yeah. I think if the market was to sell off, it could really sort of accelerate, because I think you start getting all the flow-based, the market's going to be short gamma, and they're going to start hedging that. That's going to cause people to sell the underlying. You get the CTA accounts all sort of piling into short futures positions, and then you get the vol targeting funds all coming in. We're not there yet. I mean, this is when a sort of flow-based activity that really exaggerates moves low. We're not at that point yet, but we could be pretty soon. So another big push lower if rates, if 2 years were to break out, the 2-year Treasury is to break out about 480, 5-year goes, real rates move up. We get a 550 terminal price, and I think then you start attracting those flow-based things, and that's where it starts to really to move low, which I love. I love that situation, because you can see these violent intraday swings, and that sort of benefits the day trader in me effectively rather than the swing trader. So that's something to be aware of. Flow is something that we don't see, but the banks do. This is something that can really exaggerate moves when it gets wild.
Well, let's hope so. I'd love to see volatility pick up. And I guess that should be a warning to any of you that are, if you're looking to trade long, if you got to be watching volatility at the same time, seeing if that's picking up. But I'm going to take it to our next and last topic today. And that's going to be the PCE, because maybe this is what juices the market a little bit. In my weekly video over the weekend, I talked about the PCE maybe being that catalyst that drives the market this week, that gives that volatility. I mean, we got CPI, we got producer prices. We talked a little bit about it last week, Chris, where, you said, hey, these are the inputs that we're looking at. Today we got the FOMC meeting minutes, and we were talking about it in our community. It's like, listen, whatever they said, which ended up, you hear some hawkish commentary, whatever they said, just think about that commentary has got to be more hawkish.
Yeah.
And now, following all the data that we've seen the last 3 weeks, because the Fed meeting was on the 1st.
Correct.
So with that being said, that PCE data, maybe that's the straw that breaks the camel's back, that actually gets the juices flowing in this market. How are you going to trade the PCE?
Mate, I'll say that you brought this up last week and said PPIs could, and I was saying it's probably going to be a non-event. Based on historical performance, that's usually the case. But what we did see was such a big outperformance relative to expectations. This was an outlier move. I mean, we talk about standard deviations relative to consensus. The actual outcome was significantly higher than what was looked for. And the interesting thing for me now, Blake, is that if you look at core PCE deflator, which is one the Fed look at pretty closely, the market's expecting that on Friday to be at 4.3%. Now, that hasn't been revised up as a result of the PPI number. So instinctively, I would say that there are upside surprises or risks, should we say, to that 4.3% consensus. The algos are going to key off that straight off the bat. They're going to run positions far quicker than you or I will be able to enter or exit those positions. So I wouldn't trade around it. But yeah, I think there's probably are upside risk based on that PPI and the fact that consensus hasn't been moved up. If we were to get 4.5%, then I think that really opens the door. 25% chance of a 50 basis point hike in probably becomes 30. You get the 2-year Treasury moving up a little bit higher, and Nasdaq comes off. Failing that, with the market quite bearish at the moment, I think sentiment is starting to turn. It feels to me anyway like quite bearish. That that if we were to get a weaker number, let's say 4.1% or so, that could be enough to cause the Nasdaq to rally, the dollar to come off, dollar yen to come off. So I think it's, traditionally CPI is always the one that moves the markets. But core PCE, given how sensitive we are, maybe this is something that could inspire the risk bulls effectively if a lower number comes out. But as I say, given that PPI input, one suspects there probably are upside risks. How do you feel about that?
Yeah, well, that's a great point that you bring up, and I think that everybody should take heed of that. And one of the other things I want to point out, and I know we're going to talk about this in our setups, the dollar's been trading very strong. Bounces have been very shallow in the euro dollar pullbacks have been fairly shallow, and you're starting to see breakouts almost across the dollar curve. Yeah. So that's something I think we need to respect, especially if the number comes in stronger, as you allude to.
Yeah, I think the risks are still for a stronger dollar in this environment, but it's not the checklist for an outrageous US dollar bull market like we saw in Q3 of last year. Probably aren't there at the moment. Well, they're certainly not there at the moment because the rest of the world is still in a reasonably good spot. The US hasn't got that natural exceptionalism story, although it is becoming somewhat that way. But my checklist for an outrageous US dollar bull market are not there at the moment. But probably given the trend, we got a modest US dollar sort of position that we've got at the moment. So that's my view anyway. Anyway, so let's go to...
I'm sorry. I know we need to move on, Chris, but is it a semi-smile or a smile?
Semi-smile. Yeah, where would it be? It would probably be sort of, it wouldn't be quite on the right. It would sort of be northeast, okay. As the crow flies. Yeah, there we go. Yeah, so I understand what you're saying. Anyway, let's go to some of the charts. So let's pictorialize this one. Right, so set up, Blake. I want to bring up euro dollar first of all because we talked about this dollar view. Let's have a look at that one. Okay, so for me, if I look at rate differentials between the US and Europe, go back to that peak that we saw recently when we were trading at 110. We saw the US 5-year Treasury, if you want to use that part of the curve, wearing a 120 basis point premium against German bunds. That's now 150 basis point premium. So relative rates have gone up in the US relative to Germany, for example, now 150 basis point premium. And you can see the effect on euro dollar. It's come right back down to these levels. Price is getting sold off every time we go into that 5-day exponential moving average, which is that orange line you can see. I love to see that situation, when we're trending, just using that as a basic mechanical stop, on a daily close above that level, then get out of the trade, or you can use a 3-8-day crossover, whatever you want to do. It separates the emotion. But this is breaking down now. Can we break down into that January 6th swing just below 105? Blake, how are you seeing this? You got any reason? I know this is a daily chart, but have you got any reason to be buying now, or you stay with this one?
No, I think anywhere between 105 to maybe the 200-day moving average, which cocomes in around 103.50. Those are going to be my levels that I'm looking to buy. I'm not a euro bear. I'm actually more of a euro bull.
Correct.
But I happen to be a dollar bull at the same time. So, I am looking to buy dips in the euro. But at this point, like I said, the pullbacks have been, or the bounces have been really shallow. And we closed today at a new trend low that's below or right at 106. So it does seem to me that we're going to open up some downside. The 38% retracement of this entire move up comes in around 104.60. So that would be like an initial target for me, around the.
Well, we've closed through the 78.6 of the. If this rally we've seen this year, so it suggests that there is a probability. You can talk about oversold and all these various factors, but the market's the positioning's still quite so parts of the investment community are still very much long euros at the moment. And if you look at terminal pricing, the market's pricing what I think is a pretty aggressive hiking cycle for Europe, whereas I think there's more to come potentially in the US. So I would say the balance of risks still remains selling rallies, and that this time next week we'll probably be closer towards that swing low.
Yeah. All right. Well, I'm going to be keeping an eye on it, and I tend to agree with you there. But this is going to be a controversial one, Chris. Let's take a look at the U.S. dollar Japanese. The U.S. dollar Japanese yen. Can you pronounce his last name for me? Oida. Okay. So the BOJ governor is going to, the nominee. He's going to be going in front of Parliament this week. And this is a point that I've been making all since last week and on my weekend video. Look, BOJ governor, politicians, I don't care who they are, somebody that's leading somewhere, they're going to say whatever they want to say and to get the job. But once they get in that position, their actions are going to speak louder than words. I'm going to tell you,
I love that.
Right now, that there is no one more extreme than drunken, BOJ Kuroda right now. And when he's off the throne and you put Ueda on there, I'm going to be buying yen. And so I'm just hoping we get a spike up towards the 200-day moving average, that 38% retracement at 136.50 to 137 level. That is going to be my fade area. I've been thinking about that all week, and I'm just hoping we get a spike up there by sometime midweek. What do you think about this trade setup there, Chris?
Yeah, look, I think it's, that he is going to be going to Parliament. It's actually a name very close to my heart. What they call in Japan, they call it the Diet. So he's going to be appealing to them. But I agree. I mean, I think that the risk reward comes in just waiting for a little bit more squeeze in dollar longs. That probably coincides with a little bit more of a squeeze higher in yields, and obviously, terminal or peak pricing in Fed funds, US swaps, for example. But I agree. I think you nailed that. That's a really, really, I haven't heard, it's a really good way of thinking about it, that he will say what needs to be said. And that's likely to be that, the current policy is the right policy. And I know that there are people within the Diet that want to see a more hawkish situation. They look about the unforeseen consequences with, buying all the Japanese government bonds that are out in circulation, with having, ultra easy policy. Let's also remember that tomorrow, and I'm saying this might, Thursdays, that we do get national CPI numbers as well, and they're expected to increase to 4.3%. But I think that's actually going to mark a short-term peak in Japanese inflation. But I think that could be just as important. So the yen's going to be interesting because we're getting inflation numbers, and we're also getting Oida speaking to the Diet there. But I agree. I think you coin it well. He'll say what he needs to say to get the job done when he's actually leading the committee. And obviously there's other forces as well, the deputy governor and all that. But what he actually does when he's in the job is obviously going to be very different. So I like the trade. I quite like selling into those. I want to take it back to school, Westy School Day. Let's go into have a look at rates volatility. Rates vol, not volume. Vol means volatility. So what we've got at the top here, I think this is really interesting because we talk about these moves that are happening in rates, and what I've got at the top is the swaptions market. So these effectively look at implied volatility in interest rate swaps. It's very difficult to get hold of that information unless you've got Bloomberg Terminal, but what you can do is you can get one on the bottom. It's called the Move Index, and this looks at implied volatility across treasuries. Very, very correlated, and you can have a look at that on your trading view chart. You can actually get the CBOE interest rate volatility there, but it's a different one from this. And but the Move is the one that I would look at from a trading view platform. Now, what you can see there is that period through October into basically through Q4, the interest rate volatility subsided quite sharply, and that led to a situation where the dollar really underperformed relative to G10, and we saw some big moves there. You can see the dollar index in that sort of dotted orange line. Now what we've been seeing is as the movement has taken place up and down, but generally sort of more pronounced moves from the mean in interest rate pricing, you can see that the dollar's really benefiting from that, and there's been a decent correlation from that. Now I'm not going to use the technical analysis on that. You can see it's testing the 50-day, but you can see a situation. The Move Index has moved up as well. So implied volatility in rates market has gone up. That's benefited the dollar, and it's seen equity markets coming over. For me, when I'm looking at risk gauges, people talk about the VIX and all these factors. I'm looking at interest rate volatility, because if that continues, that move index goes for 130, there's no doubt in my mind that the Nasdaq's going lower. You're going to see interest rate hikes being priced in, and so that's a really important one. So I'm looking at, people are saying, oh yeah, the VIX this, VIX this. Have a look at the move index. Have a look at the HYG. Have a look at rates vol. That to me is the key one there, Blake.
And when you're on TradingView, just put in MOVE, and exactly. And I'm going to say you've been spot on with that. And as rates are moving globally, volatility is picking up. So that move index, as it picks up, that's just going to imply, as Chris pointed out, more dollar strength. So I hope you all had your pen and paper.
I didn't give you much time to speak there, Blake. Apologies, mate. I just went on a bit of a rant.
No, that's okay. That's perfectly fine with me, and I'm sure it's perfectly fine with every Pepperstone client that's listening in right now, which should be every one of them. All right, I'm going to take you to my setup. My last setup here is Bitcoin. Bitcoin, I want to show you this really, really fascinating chart. When Bitcoin went into a free fall, back in whatever year that was at, 2021, when we fell like that. I guess it was like at the it was beginning of 2022. We spiked down below 25,000. 25,000 was like that spike low. You notice that we've rejected it every time on a rally. And I think my Forex analytics, traders that we talk to every day, we mentioned the price 25,000 so many different times over the course of the last year. People probably get nauseated hearing me say it, but even the last few trading sessions, 25,300, really big level of resistance. Right now it's a triple top, could be a quadruple top. We know that it's big, so if we get much above 25,500, it's actually a bullish breakout. However, if we break below 23,300, that's the level that I'm looking at for a neckline. That should take us right back down to about 21.5. And that's a pretty big move. Percentage-wise, it's a pretty big move. So if you're a crypto trader, keep an eye on that. What do you think about Bitcoin here?
Well, it's the first time I've seen you putting these fancy graphics on. The written. It looks really nice, to be honest.
Thank you.
I was really hoping it would break that level, because I want to see it going. I love momentum moves. I don't care the asset. If it's moving up, I want to be involved in it. Just have the right momentum strategy and try and extract most out of the trade. Obviously, cut that position. So I was actually hoping we were going to get that break, and it was going to lead to a nice move higher. We're going to get FOMO capital chasing it up, and I would have been set. So I was actually really hoping for the close above that level. It hasn't happened. And so I'm still, I'm not doing anything with that. But yeah, I love Bitcoin and crypto as a sort of momentum trading vehicle, and it hasn't happened. So yeah, I think there's probably two-way risk at the moment. I'd want to see another break, another test, and a close. But yeah, again, it's wait for the close above that level and go from there. But I like what you've done with the graphics there, Blake. You've made it look really nice.
Thank you. There's an old saying too: triple tops builds stops. So just remember that one.
That's right, mate. That's right. But when it does break through, it can be very, very powerful indeed. Anyway,
right.
So I want to have a look. I want to have a look at play of the day today. Right. When I woke up this morning, I thought to myself, let's have a look at the charts. And obviously, we knew what was going on. And I thought to myself, do I want to choose Nat Gas because it's just absolutely flying? It's one for the brave, as we talk about. Do I want to have a look at crude because crude's being smacked at the moment, and we're looking to trade down to the lows of the range. But I thought to myself, I like the dollar to an extent, but what's the best way to express a strong dollar view at the moment? It's against the weakest currency. The weakest currency is obviously Aussie dollar, so that's what I'm looking at here. So Aussie dollar, we saw a weak wage number. The rates repricing a little bit, but look at the technical setup. And I also thought to myself, what's the one Blake would probably arguably want? And Blake, what is the one you really wanted to use your player of the day? It's
Aussie.
Yeah, there you go. So anyway, so I've read your mind. But look at it. I mean, yeah, for those who like head and shoulders pattern, there's a pretty clear one that's come through there. You're targeting that sort of yellow box down at the bottom as a sort of a technical target, so to speak. We're just holding on the 200-day moving average at the moment. I actually quite like selling. I'd want everyone actually to see a little bit more strength into that sort of red horizontal, which loosely you can see, and the market sell off, a little bit of a push higher. I'm not sure if we're going to get it. I like selling the weakest. I like buying the strongest. Right now, Aussie dollar is the weakest. China's not really helping the situation. If you believe that the rates repricing can come in, the Aussie's the one there. But look at the technicals at the moment. If this breaks the 200-day moving average, this could start trending lower. So I like this one. I like selling rallies. I think this one goes lower here.
Yeah, and I have to say, Chris, if you take a look at the Aussie Kiwi after yesterday's RBNZ, That's definitely going to weigh on the Aussie all the way around.
That's broken out of the channel, the bull channel that we've been doing as well. So I think that the bias has switched on that one as well.
Right. Well, I'm going to stick with the dollar theme here, and my play of the day is going to be the loonie, the dollar CAD, and we're looking at a Gartley pattern. Now, they call this a bearish Gartley, and the reason why it's a bearish Gartley is because it is a straight up sell right around the 138, 138.50, maybe 138.60 level, and that's why you see 138XX, because somewhere up there around that 127% extension, around that 78% retracement of the entire highlighted area, that's going to come in right around 138.40, 138.50. So somewhere up in that neighborhood becomes bearish, but there's a leg between now and then above 134.50 towards 138 that could provide a lot of upside. And if we get a little bit of risk off, as Chris was alluding to earlier, rate expectations start moving up. The dollar Canadian, it did close, and I don't have this on the chart, above the 618 retracement of the high on December 20th to the low of February 2nd. The 618 retracement was 134.45. We closed above it today. That should give us a green light for some higher prices. We closed above that trend line. I'm looking for a bullish move. So look at us, $2 bulls. Imagine that, Chris.
If crude goes down to those lows that we talked about, that's gonna benefit this trade. There's really not much price. The inflation numbers out of Canada that we talked about, were weaker than expected. They're pretty much, that sort of solidifies the need for the Bank of Canada to go on extended pause now. So I think fundamentally your trade makes sense. The technicals suggest that's the case as well. So I like the trade. You're probably going to be proved right again, Blake, as you always are, mate. So well done. And really nice to see you moving out of the desert. There's too many dangerous things out there, and you moved into obviously the more sort of cosmopolitan areas. And I'll probably one day like to join you for a gin and tonic on those watching the golf as well. So anyway, you guys at home, thank you for watching. Obviously, if you've stayed this long, hit the like button. We really appreciate it. Leave a comment about how you're trading the markets. We always like to see those and get to them when we can. And we'll see you back next week for more of the same.